Here's wishing everybody a happy and a prosperous 2020. Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Donald Trump sets January 15 deadline to approve the phase 1 of the US-China trade deal, says will travel to China for the next rounds. Macro data back home, India's industrial production contracted for the fourth straight month in November, with 5 out of the 8 sectors registering a degrowth. India's fiscal deficit widens to 8.07 lakh crores for the April to the November period. The figure was 114.8% of the budgeted target. And airlines will have to shell out more for fuel as oil marketing companies hike aviation fuel prices for the first time in 8 months. But it is not all that bad. We may be one of the 3 or 4 markets, 3 to my best of my memory, which might be working, but it's still not all that bad because Donald Trump seems to be in a mood for giving some gifts. Now, first, before we get to that, I just want to take a rewind and remind viewers of something that could be of paramount importance as we head into the next few years. There is a chart that the Bloomberg terminal has on it, which was done maybe about 10 days back, but which takes a look back at a number of periods or the number of decades in which global markets by and large might have had recession. Now the NBER data, that's the data, it shows that this is the first decade since 1840s without a recession in the US. Remember, US is the mother market. When the US sneezes, the world catches cold. Even now, we might talk about the importance of some of the other markets coming in, but the US market is the mother market and sets the tone. This year, this decade has been the first decade wherein we've not seen a recession in the US markets, and therefore that whole clarion call of at some point of time it will come only gets louder. But can politics and central banks thwart that? That's the question. Well, there's some bit of optimism out there in the world markets because of what Donald Trump put out as a tweet late last evening US markets time, and he said that he'll be signing a large, I'll quote, I'll be signing our very large and comprehensive phase 1 trade deal with China on January 15th. The ceremony will take place in the White House. High level of representatives, etc. will be present, and he says that he'll be going to Beijing where talks will begin on phase 2. This is Donald Trump's Twitter handle, and that that gives to my mind some ammo. Asia may not react because Asia will not be open today. As I said, we are one of the few markets which are on. The SGX Nifty doesn't quite show optimism out there. The volumes would be a bit thin today, but never mind. This sets up some positivity for markets as well. Remember, we are also entering a busy period, and I'll talk about all of that as well. We are entering a busy period, earnings, pre-budget, and therefore moves could be very large and fairly volatile in the next 1 month. But for the immediate session, what is it that one is watching out for? Well, it would arguably be a day of muted volumes, and therefore large trend-defining moves are very unlikely today. I mean, we might move up a bit here and there, but I don't think any move today will set up a bit of a trend for the markets in the near term. However, we'll watch out for specifics. I mean, aside of what banks do and what Reliance Industries and the telcos do, I think autos will be a very important pocket to monitor today because to my mind, the market is going into this auto sales numbers with some degree of optimism about what the numbers could be like. The stocks have also shown that if there is weaker than expected monthly auto sales delivery, then that could dampen the sentiment for the auto pack and for the high frequency indicator led moves by and large. So that is something that you got to watch out for, and therefore amongst the companies to watch out for, I don't think there is anything more important today in the first half of trade than the auto stocks. So do watch out for Maruti. Do watch Maruti and Bajaj Auto arguably will kickstart the auto sales delivery at about 9:30 a.m. and then a clutch of other names like M&M, etc. will all be watched out for. So auto names are the key ones to watch out for in the session today. Aside of that, a couple of other ones which are interesting ones. Sterling and Wilson, remember, caught in this whole quagmire of whether the promoters have enough money to repay debt, whether the company will be able to reduce the leverage, etc. Well, there's some updates on the debt repayment schedule. The outstanding loans from listing now at 1644 crores from 2563 crores, and they're going to facilitate repayment of the balance in 3 tranches till September 2020. So there's a debt reduction that has happened. They've given some guidelines about how the debt reduction plan would move ahead. To my mind, this should augur positively for a company which was beaten down badly around the time when this news about the debt repayment issues came about. Let's see if Sterling Winston managed to react further positively in the session today as well. Embassy of X Parks, and there's an agreement with the Embassy sponsor to acquire about 0.6 million square feet leasable area in Bengaluru. The acquisition cost of 740 crores to be funded through additional debt. So this could be an interesting one to monitor as well. Remember, it's coming on the back of the real estate index and real estate stocks having a fabulous 2019. Can we see an encore in 2020? That's the key. Not too many other stocks which might react at 9. I mean, some of the trade-related stocks like metal names could be in focus because the metal companies, the traders might just feel that because of this trade resolution, the metal stocks and commodities might move up. So you might actually watch out for all of those names as well. But largely autos and a couple of these names. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we bring to you on day one of the new year. Yash takes us through the BloombergQuint brokerage poll on monthly auto sales numbers for the month of December. Nikki then talks about the BloombergQuint cement dealers survey. Somit Johnson on why analysts are betting on infrastructure stocks this year. And we wrap up with Alex running us through some of the alternatives to fixed deposits you might well want to make the most out of 2020. A last hurrah may not necessarily be in store for automakers in 2019. A poll conducted amongst 4 brokerages show that some players like Maruti and Bajaj may indeed see a marginal rise in sales, but that need not be enough to send them into a tizzy, especially since it has been driven by discounts. Yash Upadhyay is here for more. Yash, what are brokerages saying?
Morning, Neeraj. So most of the brokerages, they are of the view that they don't expect any fireworks as far as the December auto sales are concerned. And while there is some positive news for the passenger vehicle makers as they expect the demand momentum to be improving into the month of December as well, the two-wheelers as well as the commercial vehicle space continues to remain under pressure. And on the back of that, we are likely to see a mixed performance across the board as far as most of the OEMs are concerned. But let's look at the individual companies. Now, let's start first with Ashok Leyland. There the sales are likely to see a drop of as much as 33%, and we've highlighted multiple times over the past as well as how the commercial vehicle space continues to reel under pressure on the back of the overall economic slowdown, which is impacting the viability of the fleet operators. Tata Motors too has nearly 60% of its sales coming in from the commercial vehicle space, and again a similar story over there as well. But as far as the passenger car business is concerned, there too the increasing competition as well as the dealer destocking ahead of the BS6 transition, that is expected to have a negative impact, and we are likely to see that big drop of almost 25% on a year-on-year basis. But moving forward, when it comes to your two-wheeler or your M&M Auto as well, we likely to see a smaller drop in compared to the commercial vehicle space over here. So only about a 5% drop, and this is primarily down to the fact that we are seeing an increasing competition in the cranked utility vehicle space. We've seen the likes of MG Hector as well as Kia Seltos also come in and pushing in volumes of closer to 10,000 units per month, and that is likely to eat into the market share of M&M Auto and put further pressure as far as the volumes are concerned. So M&M could see about a 5% downtick in sales on a year-on-year basis. As far as the tractor sales are concerned, again the rural stress is likely to hurt the tractor sales, not just for M&M as well as Escorts. So we're likely to see about a 4% drop in M&M tractor sales, as well as when it comes to Escorts, about a 2% dip. Not a huge number, but there were expectations that because of the extended monsoons carrying forward and with the Rabi sowing also being positive, we are likely to see a positive sentiment as far as the rural sales are concerned. But that might not be just yet as far as the December sales are concerned. But moving on, let's also take a look at Maruti, and because of that adjusted base on a year-on-year basis, we are likely to see a marginal growth on a year-on-year basis for Maruti, about a 2% uptake, and this is again down to the heavy discounting that the dealers have given out. Additionally, the shift to BS6 from BS4 has resulted into newer product launches coming in, as well as the likes of Espresso and XL6 doing very well, with almost a stockout situation in certain geographies as well as what the dealers had told us earlier. So Maruti is likely to do better than some of the other passenger vehicle makers in the space. As far as Bajaj Auto is concerned, again there's a comfort that comes in from the export business, which contributes to almost 45% 5% of their sales. And while the domestic retail sales are also likely to do better, on and all, we are likely to see about a 5% jump for Bajaj Auto as well in this period. Moving on is Royal Enfield, and in the absence of no major discounts, we are likely to see a marginal drop of about 2% as retail sales continue to remain weak for the company, along with the likes of Hero MotoCorp and TVS Motor. So Hero MotoCorp, again, we are likely to see about a 5% drop in volumes on a year-on-year basis. Again, most of these companies will be taking price hikes from next month onwards, and that would be something that we'll have to wait and watch in the month of January. But overall, barring a few names here and there, overall it looks like a mixed month of December for auto sales.
Yash, just wondering if there is any dissonance between what brokerages have saying or are saying and what our poll or our dealer survey threw up. Is there any dissonance, or is more or less in line with each other?
No, it's more or less in line, Neeraj. So even the dealers had said that it's a mixed month. At the start of the month, the expectation was that December would be a fairly positive month, but it hasn't gone or gone on to achieve that sort of potential. But it remains mixed, with certain players doing well, like in the commercial, in the passenger vehicle space. Maruti is likely to do better, but the other two players are not likely to see growth coming in on a year-on-year basis.
Okay, Yash, thanks so much for putting that into perspective. So that's as far as auto sales go. Now, well, let's move on to infrastructure companies, which figure prominently amongst analyst bets for 2020 in terms of stocks expected to give the highest returns over the next 12 months. 4 out of the top 5 are infrastructure names. Sumit Sarkar is standing by with the list. Sumit, good morning. And what makes the street so bullish on this pack, which has largely been absent from giving returns for the better part of the last year?
Well, actually, I'll come to that. First, I'll tell you the criteria of how we have selected the stocks. So we have selected all listed stocks in India, and from which we have filtered the stocks that have more than 10 analysts covering that stock. Now, among these stocks, the 5 stocks that are expected to generate most returns over the next 12 months, 4 of them are infra stocks, and the only non-infra stock in this list is Healthcare Global. So I'll start off with IRB Infrastructure. Now, end of concession agreement for the Mumbai-Pune Expressway, which contributed nearly 38% to its total revenue. No projects awarded so far by NHAI under the BOT model, and 2 projects awaiting approval to start have been the major concerns for the road developer in 2019. However, analysts expect the stock to gain close to 90% over the next 12 months on its deal with GIC, which will help the company deleverage its balance sheet. Along with that, the company is also eyeing to bid for the upcoming 19 BOT projects worth nearly 30,000 crore rupees, which will improve the revenue visibility going forward. So this is the reason why analysts are bullish on IRB Infrastructure. Secondly, Capacite Infra. Now, the muted financial performance in the first half of financial year 2020 owing to elections and extended monsoons. Along with that, reports of tax rates also led to the downfall of the share prices of Capacite Infra in 2019. However, the company has a strong order book of nearly 11,000 crore rupees, which is more than 6 times its last 12-month revenue, which gives a good revenue visibility of going forward. Along with that, the company's focus on cash flow focused growth strategy and a strong balance sheet have made analysts bullish on the counter. NCC, now 2019 was not a great year for the company, with elections curbing order accretion, extended monsoon limiting order execution, and the newly elected Andhra Pradesh government terminating or serving stop work notice for large part of its order book. However, analysts continue to remain bullish on the counter on the back of its declining debt, expected resumption of stuck Andhra Pradesh orders, pickup in new order inflow, and Semcop claim settlement, which will also lead to debt reduction for the company. And lastly, Ashoka Buildcon. Now, a cut in annual revenue growth guidance and an overhang of an exit by SBI Macquarie Infrastructure Fund led to the downfall of Ashoka Buildcon in 2019. Now, during the year, the company had lowered its revenue growth guidance of financial year 2020 by nearly 5 percentage points to 20-25% due to extended monsoons and land acquisition issues. Along with that, the SBI Macquarie Fund is also looking to sell nearly 39% of its stake in the company's subsidiary, that is Ashoka Concession Limited. But analysts expect the stock to outperform and run up in 2020, that is over the next 12 months, as it has received appointed date, that is the date to start the project for all its HAM projects, which is expected to drive better execution starting 4th quarter of financial year 2020. Along with this, improvement in its working capital, which led to debt reduction, have also kept analysts bullish on this counter.
Okay, so Amit, thanks so much for putting that into perspective. Well, that's with regards to infra companies, and as you can see, if the sell side is to be believed, infrastructure stocks might well be the flavor of 2020. Look at those return potentials for some of the companies. All of them, without exception, over 60%, at least some of them well over 70% as well. But while infrastructure companies might do well and there are some green shoots, there seems to be no respite for cement makers, unfortunately. A BloombergQuint survey of dealers across the country suggests that prices continue to slide for the 7th consecutive month in the month of December. Project delays and oversupply continue to hurt the industry as well. Nikki Mirchandani is standing by with the findings of that survey. Good morning, Nikki.
Good morning, Neeraj, and Happy New Year to you and all our viewers out there. But then nothing changes for cement industry as such for the new year. You see the same pricing trend, rather the declining trajectory for the industry at large on all India basis. If you look at the trend, it's the 7th consecutive month of decline that we're looking at. It's a 11 rupee per bag cut. Essentially, the price cut has been driven by South. You have the Western region this time around participating, and to an extent also Central region, which has failed to show any resilience otherwise. Okay, let's look at how the South region as a whole has performed for this month now. It's a 20 rupee per bag cut, pretty much takes away all the kind of hike that the region saw back in the month of September. Now, in fact, the reversal cycle has begun. It's a 20 rupee per bag cut for December 2019. So clearly we're seeing some amount of excessive supply coming in from that region. There remains to be unavailability of sand, and the slowdown in the infra projects continue, because of which cement demand in turn has been affected. If you look at the second region that we have in our chart out here, you have West India, where you have the Maharashtra state elections and the change in the government which happened, review of the infra project which in turn weighed on the cement demand as such, where after showing some amount of resilience for October and November month, finally for the month of December we saw sharp cuts coming in to an extent of rupees 20 per bag here. So that's a quantum that we need to keep an eye out, because the cut is as sharp as what we saw back in South for the southern region as a whole. Next on the list we have Central India. Now this is a region which is relatively shows some amount of resilience out there because of amount of limited capacity additions which are taking place in the region as a whole. Nevertheless, having said that, it's for the second consecutive month that we're looking at price cuts, ₹5, but the quantum, if you compare to that to South and West, that remains to be a little lower for this region. If you see where the resilience is relatively coming in from, if I had to pick up a trend, it's going to be North and also to an extent East India. Now, if you look at the chart for East India out here, although you're seeing a price cut of ₹10 per bag, but then that again, most of the dealers have been notified that there will be a 20 rupees per bag hike coming in effective Jan 1, 2020, that's today, and we're looking out for that potential price hike, which in turn could set the cycle straight for Eastern India, where your pan-India players, majority ACC, Ambuja and Ultratech Cement could benefit from that. Also, the last region which relatively has held up, or rather not participated into the cuts that we've seen across the region, is North. Now we've seen partial ban being lifted in NCR, some amount of demand and the pickup in infra activity, which in turn has led the prices flat. I'm not saying the prices have picked up here, but they've relatively shown some amount of resilience for this region as a whole.
Well, okay, interesting. Nikki, thanks so much for putting that into perspective. So that's as far as the cement makers go, and no such luck. Infrastructure may have high return potential, but that's also in part because the stocks haven't done well, because the business hasn't quite picked up, and therefore that plus real estate activity having been muted, amongst other factors, clearly leading to both the price and volumes going down for cement makers for the better part of the last 12 months. I think 7 months on a trot now, if my memory serves me correct, that we said that prices have come off, and that's not a good sign. Could the stocks deliver? Well, time will tell. The last piece on First Word is about something that we Indians have an affinity for: fixed deposits. It's been one of the preferred investment options across generations, but there may be a number of other options in the debt space which are relatively safe and give higher returns. Alex Matthew is here to tell us more about it. Alex, good morning. And I'm so looking forward to hearing this, because yesterday on the way back home I had a chat with a friend who's got large dollops of money in fixed deposit. And her question to me was, and it caught me by surprise, but I realized that there's so much of disbelief out there. Her question to me was, I do not want to go into debt mutual funds because they don't give me fixed returns. Fixed deposit gives me fixed returns, and therefore I want to be safe. People don't know of the alternatives.
Absolutely, and I think that's critical to know before you make any decisions. Neeraj, first of all, Happy New Year to you.
Happy New Year to Alex.
And indeed to all of the viewers of BloombergQuint. I think it's important to talk about fixed deposits because growing up, I think the one product that you definitely heard about, that your father spoke about or your mom spoke about, was fixed deposits. But we're in 2020 now. And the reason we're talking about alternatives to fixed deposits now, Neeraj, is because fixed deposits yield you much less than they did at the start of 2019. Because over the course of 2019, you've had rate cuts to the extent of 135 basis points. So yesterday, when I looked at the rates offered by State Bank of India, you have fixed deposits more than 1 year offering only 6.25%. Now, some people may look at that rate and say, hey, okay, that's fine, because I know that my money is safe. But you have to also account for the tax element. Now, what happens in fixed deposits is that the entire return that you get on your fixed deposit is taxed at the marginal slab rate. So what that essentially means is that if you're in the 30% bracket, the return that you earn from your fixed deposit goes and sits above your salary or income for the year, and that entire return gets taxed at that 30% rate. So effectively, if you've got 6.25, just for the sake of calculation, 6.25 rupees on a 100 rupee fixed deposit, a third of that is gone, okay? Now, a few people may still say that's fine because your money is safe, but you have to account for inflation, right? So inflation is hovering around 4% or thereabouts. So effectively, your money is all gone. You have 100 rupees now, you will have 100 rupees accounted for inflation at the end of the year. So that's not very efficient, which is why we're talking about the alternatives. So let's get down to it.
Let's face it, inflation may be 4% headline, but the household inflation is much higher.
Absolutely, absolutely. And the objective of your investments is to safeguard against inflation.
True.
Right? So let's talk about the alternatives. The first one and the first couple are essentially similar in nature to the taxation of fixed deposits, but they give you higher returns. So the first one, there are deposit-taking NBFCs like Bajaj Finance, and effectively they give you a higher rate of return, so you make that spread. Okay. Right? So I checked the deposit that was offered on Bajaj Finance, 3-year plus deposits are giving you as much as 8.1%. So there's a significant increase in the amount of interest that you earn. Of course, when you're talking about a safety of the deposit, they're offering you because there's a higher risk involved. But still, when you're talking about a AAA rated company like a Bajaj Finance, relatively lower risk than other stuff out there. So the second one we've spoken about a lot, Neeraj, in the recent past. You've done shows on it. You've done conversations at the Bharat Bond ETF. It was just launched. A lot of the experts that I've spoken to, I'm sure you will agree, have said that you should consider subscribing to this and hold to maturity.
Okay.
Because of the index.
Hold to maturity means that I buy and I hold it for the entire period of the bond.
Yeah.
Is it?
So between now and March, if you subscribe to the issue, you will get 4 indexation benefits in that for the 3-year bond and 11 indexation benefits for the 10-year bond. Now, in case you don't know what that means, it's very simple. And this is where it's different from your fixed deposit. What happens is that your indexation allows your return to be adjusted for inflation, and that gets taxed at LTCG. So long-term capital gains gets levied on your returns minus your inflation over a period of time. That's effectively it. That makes it beneficial.
So which means that the accounting cost of acquisition of this might become higher because of every time I get an indexation benefit. Is that a simple rule? Is that a simple
very
explanation?
simply, Neeraj, if you're buying the 3-year bond or the 3-year ETF that's culminating in 2023, you get 4 indexation benefits. So you essentially have inflation for 4 years. Even if you take it at 4% just for calculation's sake, effectively that if it's giving you about 6.5%, 7%, you're only paying tax on that 2.5%, 3% incremental number,
Okay.
right? And it's lower because it's 20% LTCG, whereas if you're in the 30% bracket, you're paying 30% on the whole amount, right? So that's a significant one. The other one, it doesn't come around very often, but there are publicly issued corporate bonds. There are several companies out there that need capital, so they issue bonds that normally go to the big buyers out there, the mutual funds and the banks and all of the insurance companies, but sometimes they issue it publicly, so you can actually subscribe to them. They don't come around very often, but it's a good idea to keep your ear to the ground and find out where they are, because they give you a higher rate of return. Now here too, the interest that you get, the entire amount, you're paying based on your slab rate. So in that sense, it's similar to a fixed deposit, but it'll give you higher returns. The next one is, we've spoken about it, mutual fund debt schemes, and there are several under that category, 12 or so, that come under various aspects. So you have gilt funds, you have corporate bond funds, the much maligned credit risk funds. But within that, you have to understand that you're subject to interest rate risk. Now, very simply, you have to understand that yields and prices in bond markets move in opposite directions. So when you have a situation where the RBI is cutting rates, you have a situation where the prices are going up. So your portfolio is growing, but you're yielding less, right? So if you're buying new, you're getting less. But if you're holding for a while and interest rates come down, you're getting more. But on the other hand, if your interest rates go up, you're losing capital. So that's something that you have to bear in mind. If you want to negate that, there are two options that you should consider. You can consider rundown schemes, and you can consider fixed maturity schemes within debt mutual fund schemes. Again, indexation benefits kick in after 3 years, which makes it a more efficient option. There's also the Public Provident Fund. I think most experts will stress that everybody must get a Public Provident Fund. You can buy one for your kid as well. It's something that has a maturity of 15 years, and as of now, it's yielding as much as 7.9%. You can invest up to 1.5 lakh rupees every year, and that entire amount, if you're not making any other savings under ATC, is deductible from your taxable income. And what's more, the returns that you get at the end of 15 years are completely tax-free. So that's a really beneficial thing. Then you also have RBI bonds, which are less heard of. I must admit that I hadn't heard of it before I spoke to a financial planner yesterday. He said that you can buy it from your bank's website. And it gives you 7.75%, which is more than a fixed deposit anyway. But you still get taxed at your slab rate. So several options out there. In fact, there may be more, but these, I think. And one very important point, Neeraj, is where if you're investing in equities, and you keep stressing this, you must diversify. You can do that with your debt investments as well. You can keep a core amount in your fixed deposits, but you can also diversify.
Okay, just very quick follow-up, Alex. Aside of, so the Bharat bond ETF would tax you at 20%. All the other options will tax you at 30%, but they give you a higher rate of return compared to the fixed deposit, right?
No, so long-term capital gains tax is 20%. So on your debt mutual funds, you get indexation benefits and you get long-term capital gains.
Okay.
Even in your corporate bond, if you're holding, if the value, so 100 rupees, if the value, like I said, the price and yield, so if you sell before maturity, and if that 100 has gone to 102, then you're paying long-term capital gains on 2 rupees.
Okay.
But on the interest component, you're paying based on your slab rate.
Based on the slab rate. Okay, great. Alex, thanks so much for putting that into perspective. And I think it's important from a perspective of all of us who have money in fixed deposit, or parents have money in fixed deposits, to try and urge them to take a look at these options available, because a lot of them are almost as safe as a fixed deposit. There's quite nothing as safe as fixed, but they are almost as safe as a fixed deposit if you go and try and figure out the nature of that investment as well. That's all that we have on First Word today, but lots more lined up on Indian Open. Will 2020 prove to be a year when the power sector finally sees a turnaround? We speak to Deepak Amitabh of PTC India about the same. Gold loan companies made the most of the yellow metals rally in 2019. Will they continue to shine this year? VP Nandakumar of Manappuram Finance joins in to talk about that. But after this break, a full tilt towards the day's trade.